Hey, and welcome back to Lucid Equity, the channel that turns the confusing parts of money into one clear, simple move. Today, we're cracking open one of the most powerful and most misunderstood legal loopholes in the entire tax code. If you're a high earner who's been locked out of a Roth, this one's for you. Let's get into it. If you make over $168,000 a year, the IRS says you can't put a single dollar into a Roth IRA. But the wealthy have used a completely legal loophole for years to get in anyway, sometimes $47,000 a year of tax-free growth. It's called the Backdoor Roth. Congress has blessed it. And by the end of this video, you'll know exactly how to do it, and the one mistake that turns it into a tax bill. Quick recap of the wall. A Roth IRA is the best account in the tax code. Money grows tax-free, and it comes out tax-free, forever. But the IRS doesn't want high earners getting that deal directly, so it sets income limits. For 2026, if you're single, your ability to contribute starts phasing out at $153,000 of income and disappears completely at $168,000. Married, filing jointly, the door closes between $242,000 and $252,000. Cross those numbers, and a direct Roth contribution is simply off the table. But here's the gap Congress left open. There is no income limit on converting money from a traditional IRA to a Roth IRA. None. Anyone at any income can convert. The Backdoor Roth is just using that open door on purpose. So what is it? Strip away the jargon, and it's a two-step move. Step 1. You put money into a traditional IRA. Anyone can do this, regardless of income. But because you're a high earner, you make it a non-deductible contribution. You don't take a tax deduction now, you fund it with after-tax dollars. Step 2. You convert that traditional IRA to a Roth IRA. That's it. You walked in the front door of the traditional IRA, which has no income limit to contribute, and walked through the inside door to the Roth, which has no income limit to convert. You went around the wall. Because you used after-tax dollars and converted almost immediately, there's little or no tax on the conversion. And now it's Roth. Tax-free growth, tax-free withdrawals, no required minimum distributions, for life. This isn't a gray area trick. The IRS has explicitly acknowledged it. When Congress considered closing it, they chose not to. It's legal. People just do it wrong. Here's the exact playbook. 4 steps. Step 1. Open both accounts at the same brokerage, a traditional IRA and a Roth IRA. Step 2. Contribute to the traditional IRA up to the 2026 limit of $7,500 or $8,600 if you're 50 or older. Do not take the deduction. This is a non-deductible contribution, and you report it on IRS Form 8606. That form is how you prove you already paid tax on this money. Step 3. Convert to the Roth. Once the cash settles, convert the balance into your Roth IRA. There's a myth that you must wait months between steps. You don't. Converting promptly just keeps it clean. Step 4. Invest inside the Roth. The conversion only moves cash. You still have to buy your funds. Don't let it sit there. Do this every January, and you're adding $7,500 tax-free dollars a year that the income limits said you couldn't have. Now the part nobody explains, and the reason people get a shock tax bill. It's called the pro-rata rule. Here's the trap. The IRS does not look at your individual IRAs separately. When you convert, it looks at all of your traditional, SEP, and simple IRAs combined and asks, what percentage of this total is pre-tax money you never paid tax on? Say you have $93,000 sitting in an old traditional IRA from a 401k rollover, all pre-tax. Then you do your $7,500 backdoor. You might think you're only converting your fresh after-tax money. The IRS disagrees. It blends everything. Now over 90% of your conversion is taxable, and you owe income tax on it. Your clean backdoor just became a tax bill. The fix. Before you do the backdoor, your pre-tax IRA balances need to be 0 on December 31st of the conversion year. How? Roll your existing pre-tax IRA money into your current employer's 401k if the plan accepts roll-ins. Most do. That sweeps the pre-tax money out of IRA land, so when you convert, there's nothing to blend with. So for many people, the real first move isn't the contribution. It's clearing out old pre-tax IRAs first. If the regular backdoor moves $7,500, the Mega Backdoor can move up to $47,500. But it lives inside your 401k, not your IRA, and only some plans allow it. Here's the math. For 2026, the total that can go into your 401k from all sources, your contributions, your employer's match, and special after-tax contributions is $72,000. Your own regular deferral caps at $24,500. Subtract your deferral and your employer match, and whatever's left, up to $72,000, is room you can fill with after-tax 401k contributions. Then you do the same conversion move. Convert those after-tax dollars to Roth, either through an in-plan Roth conversion or by rolling them out to your Roth IRA. 2 hard requirements, and your plan must offer both. It must allow after-tax contributions beyond the normal limit, and it must allow in-plan Roth conversions or in-service withdrawals. Call your plan administrator and ask those 2 questions. If yes to both, you can move tens of thousands of extra dollars a year into tax-free growth. 3 honest cautions before you run off and do this. 1. This is only for people over the Roth income limits. If you can contribute directly, just do that. 2. The pro-rata rule. If you have old pre-tax IRAs and can't roll them into a 401k, the backdoor may not be worth the tax hit. Check first. 3. You need earned income and you must file Form 8606 for the regular backdoor. Skip the form, and the IRS may tax money you already paid tax on. Used right, this is how high earners legally build a tax-free bucket the rules said they couldn't have. $7,500 a year through the front door, up to $47,500 through the Mega version. If this unlocked something for you, subscribe. We turn the confusing parts of money into one clear move every week. And tell me in the comments, are you doing a regular backdoor, chasing the Mega, or stuck on the pro-rata rule? See you in the next one. This video is for educational purposes only and is not financial or tax advice. The pro-rata rule and plan rules depend on your situation. Consult a licensed professional before making any moves.